Good evening, everybody, and welcome, and thanks for being with us. We have, as our guest of honor and speaker, José Antonio Ocampo, Professor José Antonio Ocampo, who is now co-president of the board of the Banco de la República in Colombia, and who will talk about his brand new book on the international monetary system. The discussion will be moderated by the secretary of the G24, Marilu Uy, who's the director of the secretariat of the G24, which is a representative body of finance ministers and central banks from emerging and developing countries. Marilu supports the group to coordinate and articulate the views of developing countries on the international financial architecture, the governance of international financial institutions, and financing for development. And she represents the G24 in various international fora. Before that, she was at the World Bank, holding many important jobs, including director of the Financial Sector Policy Department, that oversaw the bank's global financial sector work, and director of financial sector departments in the South Asia and Africa regions. Mr. Uy pursued her graduate studies in economic and finance in the University of California, Los Angeles. So Marilu, thank you very much for coming, and it's a partnered event with the G24 with you, and thank you very much for your partnership. What to say about José Antonio Ocampo? He has, I would say, had almost every job you can think of in the high spheres of economics and finance, but he has had jobs as a country official, in fact, twice cabinet minister, once finance, once agriculture. He has had jobs in academia for a long time now at the University of Columbia. He has been the executive secretary of ECLAC, the Commission for Latin America and the Caribbean, which in a way is half academia, half government job, I would say. And he has been, of course, the Undersecretary General for Economic and Social Affairs at the United Nations. He's also been a very active member of many commissions, among them the commission that is called the Stiglitz Commission, which I always forget what the full name is, but it's called the Stiglitz Commission on reforming the international monetary system and financial issues. He has been awarded many prizes. In 2012, the Jaume Vicens Vives Award of the Spanish Association of Economic History for the best book on Spanish or Latin American economic history. And as we were friends in New York and taught a course together at Columbia, I remember those were the days he was finishing that wonderful book on Latin American history. He has the Leontief Prize for Advancing the Frontiers of Economic Thought in 2008, and in 1988, Alejandro Ángel Escobar National Science Award of Colombia. The most recent book, which just came out, has been published by Oxford University Press and wider. And I remember the day when he went off to Helsinki to give the wider lecture. He was preparing the paper, and in the sense that was the inception of the book, I understand. I had the great honor and privilege to co-teach with him a course for 7 years at Columbia University. It was always a joy. He's extremely tough on ideas and doesn't entertain nonsense of any kind, but he's at the same time incredibly generous. And so that creates some tension sometimes with students. You want to be tough on the student, but at the same time, you're very generous, as a human being. And so I was witnessing that kind of tension in José Antonio Ocampo at Columbia. The international monetary system, in a way, is a history of the world economic and finance, and the book goes back quite a bit and presents a good grounding in the history of facts. And Jose Antonio is heart beats on the left, but at the same time, he's not, he's very rigorous with his economics. So often when we were together at meetings, I thought the speaker was letting his emotions get carried away, and was saying nice things that would be good in a wishful world, in a wishful setting. And Jose Antonio Ocampo never gives into that. He has the heartbeat of the left, but at the same time, he lets his intellect and his rigor and his economic analysis always be there. Because in the long run, of course, it's only things that work that can really help. And I think his work stands testimony to that. So I will ask him now to give a speech. After his speech, Marie-Lou will moderate an excellent panel we have, and thank you very much for the panelists for coming. And then we will have some discussions from the floor. Thank you. Jose Antonio, the floor is yours.
Well, thank you, Kemal, for that extremely generous presentation. Let me also thank Brookings Institution and the Group of 24 for giving me the opportunity to present this book and for organizing this marvelous panel with just fantastic panelists today to discuss some of the issues that are raised in this book. This is actually the book which came out late, and actually it came out, as Kemal said, from a annual wider lecture. So the United Nations University Wider Institute actually paid for the free access. So it's actually it's a free access book, which is I have found that's a great innovation. Now that I'm working in Colombia about network of the research centers and universities, I said one condition is that all your books have to be online to be a member of that association. Anyway, so it has been good. And let me also thank Ammar Bhattacharya, who I know was very active in organizing also this event. Let me just raise some of the issues that this is an analytical book. It goes through the system, or I decided to use this word, which was a source of controversy with Oxford University Press about the non-system, because the international monetary system, in a significant sense, is a non-system. It came out of the term was widely used in the 1970s, and the debates in the 1970s, and that's where I really took the concept, because after the collapse of the Bretton Woods system, which again at that time some argued that it was also a non-system, but after the breakdown of with the end of the gold-dollar parity. And the total failure to reach any agreement in the Committee of 20 in the 1972-74 meetings, and what came out has been really the source of events, of developments, with no necessarily any coherence at all, and that's why I decided to use the word non-system, which of course, as I said, was very controversial with Oxford University Press until they finally agreed that it was correct for the title of the book. Anyway, so let me actually just brief comments on 4 areas in which I do also make some proposals, so specific proposals into what I said would not be it would be a gradual transformation of the system. In fact, the system has been transforming. And I think after the global financial crisis, or as I prefer to call it, the North Atlantic financial crisis, because it was really North Atlantic, not global, in that sense. Anyway, after that crisis, there had been many reforms. which are very interesting. Some of them in the context of the Group of 20, but also the IMF reforms itself in many interesting ways. Anyway, so let me just focus briefly on 4 areas of reform. The first one is on the global reserve system, and I will focus in that regard specifically about the special drawing rights and the role of the special drawing rights, which, as I said, the book is one of the most underutilized instruments of international cooperation, and which actually has come back into the IMF debates. Actually, last year, I had the opportunity to participate in a panel on the SDRs on the occasion of the 50th anniversary, actually, of the Rio de Janeiro meetings where they were approved. Then 2 years later, the whole structure of the reforms of the Articles of Agreement were approved. And this year, actually, the topic has come back into the IMF debate. I was in the advisory group on the SDRs that they created, and actually the board document was discussed like 2 or 3 weeks ago. Anyway, so I think that's a topic which I want to introduce in particular. There are many others in the book. The second is on macroeconomic policy cooperation, which again has done some interesting advances under the G20. And one particular topic, which is the exchange rate system, which is perhaps the best case of a non-system, because there is no system of exchange rates like there used to be in both previous monetary systems, the Bretton Woods and the gold standard. I mean, they were really exchange rate systems in a very significant sense. The third is the issue of improved crisis prevention and resolution, which is an area where there had been a lots of advances in recent years, with one partial exception, which is debt workouts. And fourth, on the improved governance, in which I do have, I think, some interesting ideas of what to do. So in the case of the global reserve system, the book, I do a very extensive analysis of the special drawing rights, the history of the rights and the underutilization of the system. And the basic point that I make is that a more active use of this instrument will be one of the great innovations that can be introduced. So going back to the objectives to which it was created 50 years ago. And in that regard, the most important use that it can be made of them is actually to use them to finance the IMF lending, in a sense to transform the way the IMF finances its lending program, very much like central banks do around the world, by creating money. In this case, international money. And the proposal that I make in that regard is that the SDRs that are not used by countries should be considered as deposits in the IMF, which the IMF then can use to lend. And as the great IMF economist Jack Pollack introduced the ideas on this topic many decades ago, actually the whole IMF could be based on SDRs and forget totally about national currencies in the system. So that's, in a sense, the development of that idea. And my specific proposal is that I hope the discussion continues in the IMF now that is on the table. Now, on macroeconomic cooperation, the point I make is that the current system, in a sense, based on the mutual assessment process of the Group of 20, but also on many multilateral and surveillance exercises of the IMF, and actually very stronger surveillance of the major economists by the IMF itself, in a sense, it has been one of the major innovations of the last 10 years. And in a sense, as I say in the book, it's the most elaborate system of cooperation probably ever designed. But my point is that it's more or less useless. It has not been effective in a significant sense, in trying to in really leading to action on how to reform the system. I will go back to the institutional architecture in which the MAP process is organized, so as to introduce some ideas which actually have been tried in the IMF before, and which I think would be good going forward. But the second is in that regard, the issue of the exchanges non-system, because I think there is a lot of research now on why movements in the exchange rates actually do not correct the major imbalances in the international payments. And the big question is, if you're going to do some cooperation in macroeconomic policy, that should probably be the major focus of that cooperation. And there had been ideas on the table for a long time, but actually my proposal is some kind of indicative guidelines that will be presented, will develop probably by the IMF, or which will serve as to create some target zones of some character, or reference zones, and which will actually use the guidelines that have been already approved by the Group of 20 in the mutual assessment process. So the point is, in that regard, is how that agreement, which was reached by the Group of 20 members, could be actually used for some specific purpose in terms of the system. Now, in relation to the crisis prevention and resolution, I would say, first of all, that there have been two major advances since the North Atlantic crisis. The first one is on lending facilitated by the IMF. I think the innovations that were particularly introduced in 2009, 2010 are probably the most ambitious in history, and include this concept of contingency credit lines, which I think, well developed, will actually be a very important instrument of cooperation, but has been used by very few countries. Actually, my country is one of the very few that has used the flexible credit line, which is the major contingency credit line. So the question is, why do not other countries start using those contingency credit lines, and how to broaden their reach? And in that regard, of course, particularly in the case of the Asian economies, but also probably of many other economies around the world, the issue of conditionality is still important, and I think reducing conditionality is probably essential to eliminate the stigma associated with borrowing from the IMF. The other advance has been in the analysis of capital account issues, capital account management, or as I call it in the book, capital account regulations. I avoid the use of word controls, which is a negative term in relation to the management of the capital account. When you think of financial regulations, they're never called financial controls, right? They're always called regulations. So I think that's probably the correct name for the capital account regulations. I think the IMF has done a good job in trying to, after the crisis, in trying to see how they can use as an instrument of prudential or macroprudential management. And I think there has been some advances. Again, this issue is very much in the topic, in the agenda of the IMF right now. The area where there has been more limited advance is on sovereign debt crisis resolutions. And in that regard, actually the agenda that was attempted with the sovereign debt restructuring mechanism by the IMF in the early part of this century has been the most ambitious effort. But after the failure of that effort, there had been some agreements which actually were enhanced 3 years ago to respond to the Argentine debt crisis. And I think what was done by both the IMF and the International Capital Market Association has been a significant advance in terms of management through the market instruments. But however, I continue to think that there has to be, as many others, that there has to be a specific framework, institutional framework to manage this issue. And basically what I propose is a kind of WTO panel mechanisms in the framework of the IMF, which is the most acceptable, in which you will have successive negotiations, mediation, and eventually arbitration of debt, foreign debt disputes. Finally, on the governance of the system, I present basically three pillars of reforming the system, which will be important. The first one is the larger voice and representation of developing countries in the Bretton Woods institution. This issue has been very moderate progress in this regard since the crisis, and the issue is back on the agenda now. So I hope that we get a further advance of developing countries in the system in the near future. The second is what we call the representative organization at the apex of the system, which actually was a major topic in the Stiglitz Commission. We basically adopted the proposal that we made at the time, which in a sense could be read as transforming the G20 in a formal instrument of the United Nations system with universal membership and a constituency-based membership in the board, very much like the IMF and the World Bank operate. And I insist this is the UN system, not the UN organization, to which both Kemal and myself work at some time in the past, because actually recognizing the fact that the World Bank and the IMF are already part of the UN system in the broader sense of the term. Okay. And the third one, which has been a topic which I have worked for many years, and actually Brookings Institution produced my one book that I edited on the regional financial architecture, and I think this is a topic in which the international monetary system could develop what I call a denser multi-layer architecture. Very much like we have in the world in the areas of multilateral development banks. So in the area of multilateral development banks, we have the World Bank, a full network of regional development banks, including the European Investment Bank, which is the European one, and we have many sub-regional banks of different character. But in the international monetary system, that is almost empty system. So developing more regional institutions, trying to cover the whole world, and the cooperation between the global and the regional and the sub-regional, I think would be a much denser, better system. And the basic reasons for that is, first of all, it will be a more flexible system because the demands from different parts of the world can actually be very different. But actually, it's a system that will give a much stronger voice to small countries, which of course have essentially no voice in institutions like the IMF, but they can have a strong voice in the regional or sub-regional institutions. So it's a kind of a system that would be very much better in terms of the voice of developing countries. Okay, thank you very much.
Yes, okay. Well, good afternoon, and welcome once again to this launch of Jose Antonio's book, Resetting the International Monetary Non-System. It really is a privilege and a pleasure to be part of this event, and also Jose Antonio is such a good friend of the Group of 24 and of emerging and developing countries, and it is a pleasure to be here with him, and also for moderating a very distinguished panel. So let me just start with joining Kemal in congratulating Jose Antonio on his book. It really is a testimony of a very long career from a number of perspectives: a policymaker, an academic, a global development economist, a UN official. It's pretty hard to beat this kind of very well-rounded perspective of a book that really matters to many countries, including emerging and developing countries. Now, just before turning to the panel, I just want to offer a few remarks. The book is really extremely comprehensive and very careful, gives a very careful historical account of the many elements that have been, what I would say, long-standing issues in the international monetary system. And the non-agreement pervades, the impact of the non-agreement has pervaded the system for quite a number of decades. If one takes a look at the communiques of the G24, for example, over the past many decades, the same issues have come out. The global absence of a global financial safety net, the concerns over capital and foreign exchange volatility, and the country's ability to manage them without necessarily having the necessary policy coordination globally, the absence of, or at least the absence of a sovereign debt resolution framework system, and in a way, a governance structure where emerging and developing countries find it extremely challenging to find their voice heard. Now, what is particularly noteworthy about the book is that it provides a development link, that the international monetary system matters for development. Now, I do want to say, too, that I really was appreciative of the attempt in the book to lay out a number of options going forward, particularly to correct the inequities in the system. So, and here, Jose Antonio laid out a few of the recommendations going forward. And what strikes one is to see just what might be the forces going forward, and what might be factors that would create the momentum for finally having much more change in the system, so that it serves the global economy, not only the developed countries but also the emerging and developing countries. Now, I do want to turn now to the panel, and let me just start by providing brief introductions of the members. So we have Jim Botton, who is a historian of the International Monetary Fund, who was the historian of the International Monetary Fund from 1992 to 2012. At present, he serves as a senior fellow for the Center of International Governance Innovation, that's based in Canada. So, and before that, he held positions in in the IMF staff, as well as in the OECD. I have also the pleasure of introducing somebody who doesn't need any introduction, is Dr. Eswar Prasad, who is the Tolani Senior Professor of Trade Policy and Professor of Economics at Cornell University. He's also a senior fellow at present at the Brookings Institution. I won't run through the number of books that he has published, but among them are Gaining Currency, The Rise of the Renminbi, The Dollar Trap, etc. So, and then of course, lastly, is Dr. Alexander Tombini, who is originally from Brazil, but is currently the executive director of at the board of the International Monetary Fund. He covers Brazil, but also a number of other countries like Cape Verde, Dominican Republic, Ecuador, etc. So before arriving at the IMF, Mr. Tumbini was the Central Bank of Brazil governor. And it is a perspective that would be particularly important in the panel today. Now, I'm supposed to ask a question first to Jose Antonio. Jose Antonio, in a world that is now increasingly ever more interconnected, then the need for a much more, how do you say, systematic international monetary system seems to be ever more important. You laid out a number of proposals going forward in key areas of the system, and even a recommendation on how the governance, the apex governance of the system. Now, just to go look forward, what do you think might be the forces that would lay the path for reform, or the forces that would preserve the non-path to reform?
A complex question. I think the major force for reform is coming today from the emerging economies, which are the ones that are pushing, in a sense, first of all, making major changes in the system. Of course, China being by far the most important. So perhaps when Eswar should be answering this question. But because he has been on top of this issue very clearly. I mean, it's quite clear that China, which wants to develop an international currency and to be a more active member of the both of the IMF and the international institutions in general, but also to have a more active role in the international monetary and financial system, is by far the country that has been pushing for reforms for a long time. But I think the other major emerging economies are part of this game, and the BRICS, of course, at one point being the most important, although the BRICS, I guess, are now in a period of weakness that is interesting to discuss. But the major economies, I think, are the major force for reform. There has always been, however, in the developed world, a call for reform. And by far, of course, the most important actor has always been France. So the France actually had a series of proposals that were brought to the Cannes meeting of the Group of 20, which unfortunately were swamped by the crisis of the euro at the time. But I think the proposals from France and from Europe in general. Now the Europe, of course, is continuing deepening. It's going probably to deepen its own international monetary cooperation. I mean, this proposal on the table to create this European Monetary Fund, which is another step in the reform process. And by the way, it's quite interesting that when you think, for example, the role of the SDRs, I always, and in the book, I make the case that the U.S. Has always been, in a very interesting way, a positive agent in that regard. I mean, the topic of the SDRs were brought into the IMF because of the U.S. and because of the desire of the U.S. to have an alliance with developing countries in the IMF, in a sense, against France at the time, which had other proposals for international money. So that's an interesting background. But when you see all the major issues of SDRs have always been associated with the U.S. crisis, with dollar crisis, including the original one. The creation of the SDRs was associated to a dollar crisis, but also the issues of around 1980, another dollar crisis, and I think the issues of 2009. Which were when the financial crisis was centered in the U.S. So the U.S. has never been the SDRs are actually good for the United States. Now that the President Trump was to reduce the balance of payment deficits of the United States, it could actually be a good instrument to use the SDRs because that actually has been, for example, the proposals of Professor Stiglitz on the SDRs are always, and some others, are associated with the fact that it will help the U.S. reduce its trade deficit because of the lesser demand for dollars as an international currency. Anyway, that's probably a marginal effect nowadays. But in the cases, it shows that the U.S. is not necessarily against some of the major reforms of the system. Of course, it has to be shown by the current administration that it supports reform. The U.S. past administrations have been only partial supporters of reforms.
Thanks, Jose Antonio. And sorry to tax you one more time to and extend your presentation. Let me just turn now to, at least to start with a historical perspective, and ask Jim to give us his main reactions and key takeaways from Jose Antonio's book. You have a very long perspective on the evolution of the international monetary system, so the floor is yours.
Thanks, Mary Lou. And let me just start by expressing my thanks. It's quite an honor to be part of this panel and to be able to comment on Jose Antonio's work. I've been an admirer of him for many years. I've been writing about this stuff for almost half a century, as I guess I'm not alone in that regard. But when you spend a lot of time thinking and writing about international finance, you find that there's a lot of nonsense and a lot of confusion out there, and it's nice to find a book, which this one is, which can explain clearly and accurately what has happened, why it happened, and what the key issues are. Let me just say a few words about what I think are some of the key takeaways, and try to elaborate on a couple of these points. The biggest issue here is governance. I mean, we can think a lot about how maybe we could have a different kind of a system. Maybe we could live in a different world, but we don't live in a different world. So what we have to think about is how we can govern and live with the system that we currently have. And I think that's a big part of what this book tries to do. One issue on that is that we have to recognize that the main group, as an informal, self-appointed steering committee in the world today, is the G20. And the G24 has basically been a force for good. It's a force for cooperation among all of the large countries in the world, both the industrial countries and the developing countries, and particularly emerging markets. But the G20 has created problems for the system, and particularly for the governance of the system. And if I could try to summarize what I think that issue is, because I think it's really the key issue that we need to face going forward. It used to be that you'd have a group of industrial countries on the one side, mostly the G7 in recent decades. And then on the developing country side, you'd have another group of countries, which has mainly been the G24, particularly when we're dealing with finance. That's what the G24 was set up to try to deal with. So let's say you have the G7 on this side, you have the G24 on that side. They each meet as an informal group, and then the outcome of those discussions feeds into the IMF, which tries to create a consensus view overall to find a solution that works for the whole economy. But we don't have that anymore. What we now have is you have the G20, which brings together a subset. It brings together the large industrial countries and the large emerging markets. But that group, which also includes the whole European Union, controls over 3/4 of the voting power in the IMF. Right? So once the G20 meets and comes up with a set of priorities, a set of proposals, the game is over, right? Because then the next day, the International Monetary and Financial Committee, the IMFC, meets, and what are they going to say? Well, gee, we don't like those priorities very much. We're going to come up with our own priorities? I don't think so. So if you actually look at what's happened, you find that the interests of the countries that are not in the G24 are not being given a very high priority anymore in what comes out of the proposals, the communiques of the IMFC. And who are those countries? There are 150 of these countries, roughly speaking. They're the small countries and they're the poor countries. And the interests of the small and the poor countries as a group are systemically important but are being ignored. And I think that's a key point that to me should be the center point of the discussions going forward as to how to make the system works better. So I think Mary Lou has a big job trying to bring together all the developing countries for a discussion of that kind. But let me just stop there. Maybe we can come back to some of these issues later on.
Yeah, I'll come back. Sorry, I'll come back later on with a follow-up question. But let me now move to Mr. Tombini, who have. I mean, you have been a policymaker of a major emerging country, and have to some degree lived through a lot of the consequences or repercussions of the existing system. So I just want to give you a sort of the floor to talk about your key reactions to the book and the key issues that you saw are worthwhile tackling.
Well, thank you very much, Mary Lou, and I would like to thank the Brookings Institute for inviting me and Mr. Dervish for this invitation. I think it's a pleasure for me to be part of this panel and have the opportunity to read carefully the new book of Jose Antonio Ocampo. Let me say at the outset that I enjoy very much. I recommend the book. As you said in your introductory remarks, Mary Lou, this is a very comprehensive historical account of the evolution of the international monetary system and the global financial safety net from prior to the Bretton Woods system, but exploring where we are today and the main considerations in terms of the flaws and deficiencies of the current system. I do concur with most of the conclusions of Mr. Ocampo in his book, and when he talked about the current international monetary non-system, in the sense that you have a few biases there, one being this system being prone to instability, since it's centered into around a fiduciary national currency. I don't think this is fabricated. This is a consequence of the evolution of the system. At the outset, it was by design, but then after 71, it continued to be centered around this fiduciary national currency. But I agree that this implies that the system is subject to bouts of instability every once in a while. And the other bias, the contractionary bias, which is an issue that we continue to discuss in a place like the IMF. So the adjustment to balance of payment shocks is relying excessively on the deficit countries and very little on the surplus countries. I think this is an issue, a real issue. And the third one being this inequity bias, where countries like Brazil and other emerging markets, I think this is also an indication that the safety net is not complete. It isn't there for countries, so countries don't feel comfortable to rely only on the global safety net, so they go for seek for self-insurance, and the accumulation of this global reserve currency ends up being a form of, at the end of the day, transferring resources from emerging markets to, say, the U.S. Treasury in that case. So I I think those three biases are important, and I agree with them. The solutions proposed by Mr. Ocampo, I think they are very bold, ambitious. Although you speak about an evolutionary process, I think this is very, very ambitious for the current days. As you said, the global financial crisis or the North Atlantic financial crisis was a big momentum for reform, and we had many changes. But I want to say that the memory of this latest crisis is fading quite rapidly, I should say, and we still need to complete those reforms. And when you talk about the enhanced role for SDR, which I think is a good idea, as you said, this is an instrument, very unutilized instrument to provide liquidity. The last time was in 2009. I think you have this in your book. It's a major development. Then, but today, I think there is very little appetite for following that route. I suspect there is less appetite today than there was in 1967 when, in Rio, the IMF decided to create this instrument. And the reasons for this, you talk about the main shareholder of the IMF being supportive in the past, but I think part of the arguments against this instrument have to do first with its potential inflationary impact on the global economy, which I think this kind of reasoning has lost some appeal after the unconventional monetary policies that were implemented. And you also talk, they also talk about this idea of, well, I think the most important idea behind why this instrument do not fly is has to do with the fact that at the end of the day, the national central banks that will have to provide liquidity to this instrument. So I don't see the national central banks or reserve currencies willing to sort of resign part of their autonomy in deciding when to provide and how much liquidity to provide to the system. So I think that's the most important element behind why this is not flight. So just to stop here to say that I concur very much with the diagnosis of José Antonio, and with respect to the proposals to solve these biases, I think they are very ambitious, and I question whether they will have political feasibility, especially to having a global or an international monetary system center in an instrument like the SDR at this juncture. So I want to stop here and I come back later.
This is a good segue to the question that I'd like to pose to Mr. Eswar Prasad, Dr. Prasad. With your books on the dollar trap and the dollar's grip on global finance and the rise of the renminbi, you are uniquely positioned to talk about what might be the role of these two currencies going forward in the international monetary system.
There is a rich tradition in the G20 and I believe also in the G24 of writing non-papers. Non-papers are papers that don't have official authority or backing, so they just put out there to provoke and create new ideas. In writing a book about the non-system, I'm surprised you resisted the temptation of writing a non-book, which I'm sure would have been very well received by Oxford University Press and created even more marketing challenges for them. But it is a really good book, and it would have been a pretty good non-book as well. The job of a panelist is not just to admire, which I share with my co-panelists, and to discuss, but also to provoke. So let me take that latter role. Many of the diagnoses in José Antonio's book, I think, are spot on. But in terms of thinking about solutions, it's worth thinking a little bit about what really underlies many of the phenomena that we see out there in the world right now. If you think about the discussion about international policy coordination, especially the policy coordination among monetary authorities that took on particular significance when there were concerns about spillovers of these unconventional monetary policy actions by the US, Central Bank and other major central banks around the world onto emerging market economies. There were questions about whether central banks should coordinate their policies. There were some who argued at the time that it was the responsibility of the Fed and other central banks to take cognizance of the spillover effects of their policies onto other countries. However, my view was that that was trying to fix a certain very specific problem within each of these countries through central banks. Central banks, by that time, already had an enormous number of mandates that they were being asked to manage. And the fundamental problem that arose in many countries was the imbalance between monetary policy and other policies. So if you looked at a range of advanced economies, the fact that you did not have the right sort of fiscal policy support, or at least persistent fiscal policy support, the fact that you did not have structural reforms being put in place, meant that monetary policy was taking on much of the burden of supporting growth. And trying to fix that domestic set of imbalances, which was pervasive in almost every major economy at the time, by coordinating monetary policies around the world, would hardly have led to a better outcome, especially given the enormous set of mandates that I alluded to that central banks were already struggling with. So when one thinks about issues like international policy coordination or global imbalances, I think it's worth thinking very hard about whether the right approach to solve these problems is through coordination or using perhaps the mechanism of fixing domestic imbalances and using the international process mainly to get countries to fix their own imbalances. Now that, of course, is a problem that cannot easily be solved because interests of countries don't easily align. So certainly the point that Jose Antonio makes in his book that you need some sort of mechanism to make sure that countries can at least internalize to a marginal extent, if not more, the externalities caused by their policies is certainly an important point. The other important issue that is raised by Jose Antonio in his book is how to deal with the problems caused by the fact that these spillovers and financial fragilities more broadly lead to what Dr. Tombini referred to, which is a self-insurance because countries, especially emerging market economies, feel beset by these volatilities in capital flows and exchange rates that are beyond their control to some extent. And in fact, there is a perverse element to the classical answer that economists, including myself, used to offer at a time, that what emerging markets need is good policies, you need good and deep financial markets that are well regulated, and then your problems can be controlled. What we learned is that the perversity arises from the fact that when you have very low interest rates in the advanced economies and there is a search for yield by investors, where do they go? They look to those countries that have deep and liquid financial markets, that have good regulatory frameworks and that have good policies. So in fact, those countries like Thailand and Malaysia, right after the QE operation started, are good examples of these. Those are the countries that end up facing whiplash due to these capital flows. So the question then is, how do you solve the problem? The solution proposed in Jose Antonio's book is an elegant one, having the IMF at the center of it. And as he pointed out, the IMF has in fact taken a number of steps to create new instruments, such as the flexible credit line, which is for countries that have policies that are very good, the precautionary credit line for countries that are not quite as good, the PLL is for countries which are not even that good, but still hope to get some lifelines from the IMF. And yet, even for the flexible credit line, which is at some level a good housekeeping seal of approval from the IMF, only Jose Antonio's country, Colombia and Mexico and Poland, signed up. It's hardly like countries were beating down the door to get into those programs. What explains that? I think there is a fundamental problem with putting the IMF at the center of this. I used to work at the IMF, wonderful place, but I think the difficulty when thinking about putting the IMF at the center of the global insurance mechanism is that it takes one very important function that, in my view, the IMF does extraordinarily well, which is surveillance, and adds it with the insurance function. And as I've argued in one of my books, those functions are inherently incompatible. So if you think about Colombia right now signing up for the FCL, It is great. Colombia has had multiple extensions of the FCL, so it continues to be great. But if policies in Colombia were to turn a little weaker, if you had larger fiscal deficits, rising debt levels, the IMF would, because it would be doing its surveillance function well, not be able to qualify Colombia for the FCL anymore. And that would immediately bring the wolves to the door. So the problem here is that the IMF's qualification for the FCL and other programs has the right concept behind it, which is ex-ante conditionality rather than ex-post conditionality. But when mixed in with the surveillance function, the ex-ante conditionality conveyed through qualification or lack thereof for these programs conveys information to the markets. So what I've argued is that what you need to think about is what countries really want. When you think about it that way, at one level, it becomes blindingly obvious. What do countries want? They want insurance. If you think about how we go out and get insurance, we get insurance by paying premia. If you happen to have a 15-year-old daughter that I do, once she starts driving, I fear the day, but once she starts driving, insurance premiums for her are going to be higher because potentially she's a riskier driver. If you think about driving histories, and the analogy here would be countries that have run large budget deficits or high levels of external debt for extended periods, those countries would have higher premiums, but one could set up a schedule whereby you have premiums linked to observables. And the critical issue there is that when you think about these premiums paid by countries, there would be no information conveyed to markets. In my book, I have more details about how this insurance scheme would work. And I would argue, in fact, that this sort of backstop may actually reduce global imbalances, exactly as Jose Antonio has suggested, because you wouldn't have to self-insure by acquiring foreign exchange reserves. You could actually buy into an insurance pool that could be backed up by lines of credit offered by the big three central banks. We did have the G3 central banks offering bilateral swap lines, but these came up exposed, and these were allocated clearly not just based on economic criteria, but on the basis of some political criteria that were ill-defined as well. So emerging markets countries learned after the financial crisis that you cannot quite rely on the big central banks, including the Fed, to provide these lines of credit. So institutionalizing ex ante these swap lines through a mechanism like the insurance mechanism that I proposed in one of my earlier books, I think would be the right way to get around this problem. So the issue of insurance, I think, which Jose Antonio identifies, is a really important one, but structuring that mechanism is crucial. Now, having said that, the one point one must acknowledge is that the reason this comes up is because there is a sense that the governance mechanism of the international monetary system, and in particular the IMF, needs fixing. That is, I think, the heart of the problem. If you were to have an international institution that did, in the eyes of the emerging market policymakers, put their interests on par with the interests of the major shareholders, that would change the nature of the game. And perhaps that is what we are leading towards now, with China setting up its own institutions that might not only create some competition in the international monetary system, but also light a fire under the existing financial institutions to reform their own governance structures. So one can well see many of these developments that have taken place over the last decade leading to a potentially better international governance system. It's been a while since I've been on a panel at Brookings or heard a panel where the words that the US has been a positive force have been uttered. I was very glad that Jose Antonio uttered it, although he seemed to put it in a somewhat historical perspective. But I think having the key shareholders recognize that it is in their interest to have a governance system that puts not just their interests, but those of the emerging market economies and other shareholders on par is going to be important. And that is the sort of international governance system that I think Jose Antonio correctly points to would fix many of the imbalances, both in terms of current accounts, but more conceptually in terms of the many imbalances that we see across the global economy. So this is a book that I think needs to be taken very seriously in terms of identifying problems, potential problems, and in terms of making us think very hard about solutions.
Thank you very much for the provocative statements as well. Perhaps I have to go back to, let me go back to Professor Ocampo to react to the proposal of a global insurance system.
Well, that is, I mean, all the, in a sense, the ideas of this global financial safety net, in a sense, are about providing some form of insurance, and Hesworth has, of course, made some of the interesting proposals in that regard. Actually, you can let me just underscore one point that I made at the end of my presentation. I think a much better system would be what I call a dense multi-layer system, in which you have institutions at all levels. Actually, I forgot to say, when you think of the global financial safety net, to start with, as I point out in the book, by far the largest mechanisms are the swap credit lines of the Fed to other central banks, which basically developed countries' central banks. I estimated that at the peak of the crisis of 2009, 2010, it was like 4 or 5 times the IMF lending. So it's really by far the most important mechanism of cooperation. Anyway, so you have that system, you have the IMF, but you also have the regional financial arrangements, and I think a collective system which is denser. It goes down the hill, let's say, towards more regional institutions. I actually have lots of fun for regional arrangements, because we actually have in our case a very functional one, which is the Latin American Reserve Fund, which is not quite Latin American. It has 8 members, but it was originally Andean, and it has been, as I point out in the book and in other writings, actually. It has provided more lending than the IMF, still being a very small institution. Of course, you exclude Venezuela, the couple of Venezuela major programs in the past, but actually it's the only lender to Venezuela now, by the way. It's the only international mechanism that is lending to Venezuela in its current crisis. Anyway, so the idea of an insurance, of course, is a great idea. It could be an alternative mechanism. In a sense, the flexible credit lines is kind of insurance. I mean, you need money, you can use this. And it's also an alternative to self-insurance, because you say, well, you don't have to accumulate foreign exchange reserves, but you have these funds that you can use in case of a crisis. Anyway, so I really think, in a sense, the idea of broader use of contingency credit lines is the closer thing in the IMF framework to insurance. It's kind of insurance, and it could be, that one could be a way to go, or explicit to an insurance mechanism of some sort. Anyways, the question of who provides the insurance, of course, it would then be a major issue.
I'm conscious that we're over the time. I'm supposed to turn to the audience at 5 p.m. So we're a little bit over time. So I'd like to then seek questions from the audience and direct it to the panel members.
Hello, I'm Rick Rowden with Center of Concern. Jose Antonio, can you tell me your thoughts about the limits of Chiang Mai Initiative, the BRICS, the New Development Bank? Some people were disappointed when they made the rules that said they would only lend if the country was in the good graces of IMF. So they felt like the spirit of the alternative was sort of undercut by those kinds of rules.
Perhaps we could take 2 or 3 questions.
Thank you very much. Jose Antonio, you were talking about increasing the density of the institutional structures for the monetary system. And I just wanted to push you are you thinking about the analogy to the regional trade associations that then kind of sapped away some of the influence of the WTO, and how you would be linking that kind of dense ecosystem of monetary arrangements?
So while we're waiting for the questions, let me turn to, I think both questions were.
Maybe I just can
Come on.
check one thing. I mean, the whole debate has been on the reserve asset and the insurance and so on and so forth. But what about policy advice of the IMF? Have we seen an evolution there? Because that is always one of the big topics, particularly, of course, in Greece, it was again a big topic. So I wonder whether just one or two words on the policy side, have we seen much change?
Okay, so I'd like to first address the two questions that were directed to Jose Antonio, and then for Kamal's question, I think that it should be directed to, we'll direct it to a few of the panelists and quick answers to the question, because it's such an important question.
Well, Chiang Mai, as well as the later BRICS, okay, yeah, have one peculiarity, which is that after a certain amount of lending, it has to come to the IMF. My view is that it makes it totally ineffective as a mechanism. Actually, for example, the Latin American Reserve Fund has never had any association. It has never lost a single cent in lending to its members. And in a sense, it has no conditionality. Very much like the swap credit lines of the Fed. No conditionality. And actually, if we think of expanding a system, it has not, I mean, one of the major problems historically with the IMF is, except in the origins of the IMF, which I guess Jim can talk about that, is the rise of conditionality. Actually, in a sense, the conditionality associated with all these credit lines is a major source of the problem. I mean, you want to expand the system and to create a true insurance mechanism, or you have to think of a system in which conditionality is less actively used, or in many cases not used at all. Again, like in the Latin American Reserve Fund, zero conditionality. I mean, not quite. I mean, a couple of cases actually, including Venezuela now, but also Peru in the 1980s, there was a bit of conditionality, but generally never something like having to come to the IMF for approval. So this, by the way, has in the many debates I've been on the Chiang Mai, it has always been a point that the Chiang Mai will never work if it's associated to a conditionality of the IMF. Because actually, in a sense, the countries are reacting against IMF conditionality. By the way, my country, Colombia, had a major confrontation with the IMF in the late 1960s, in the 1967 lending program. And after that, one of the major objectives of the Colombia was never to come to the IMF. I mean, for decades, it was a major objective of Colombian policy not to come to the IMF. That's the same case of East Asia. East Asia doesn't want to come to the IMF for lending, unless there is some mechanism that, in a sense, is not conditional. Again, there are many non-conditional, by far the most important being the swap credit lines. So now on the issue of density, I would prefer to use the multilateral development bank system as a model, rather than the trade agreements, because the trade agreements cross across all lines, and they don't have the major, I think, a result of the regional arrangements in finance, which is to give voice to small countries. I mean, for me, that's one of the basic advantages of what we call a denser system, that it gives voice to all countries. Even take, for example, Latin America, actually, the Caribbean have the most elaborate system of development, of multilateral development banks, because we have the Inter-American, where we also have the Andean Development Corporation. Actually have the paper from them here in which is now called the Latin American Development Bank, because it's actually Latin American more than Andean now. But we have also the Central American Bank, Integration Bank, and we have the Caribbean Development Bank. And those institutions, I have had opportunities to participate, are very good because of the many forms of cooperation you have. And the strong voice it gives to members, to small country members, which you don't have in the larger international institutions.
Let me turn to Mr. Tumbini on the question of the evolution of the IMF advice.
Well, thank you. If I may say just a word on this multi-layered financial safety net. This is a point that I disagree with what you have in your book, Mr. Ocampo. I participated in the negotiation of the CRA, the Contingent Reserve Agreement of the BRICS. And our view from the perspective of the Central Bank of Brazil is there is no competitor for the IMF as far as surveillance and the design of conditionality is concerned in crisis resolution mechanisms. So to have an agreement and sort of duplicate what the IMF has and having the IMF universal membership, so we wanted to go for zero detachment of the IMF. So we saw the CRA as a complement. I mean, we agree with making the safety net system more dense, but as a complementary to the IMF at the center of the global financial system, because the IMF is second to none in terms of the ability, the capacity to survey and to design programs. So that was the idea. But with respect to policies, very quickly, I think the institutional view that Mr. Ocampo mentioned in his book was a step in the right direction in terms of the policy advice of the IMF, acknowledging that countries like Brazil, and we were in the forefront of sort of having to resort to some measures or capital account regulations, because prior to the global financial crisis, I think we could deal with these vagaries of the international financial flows in the sense that we will perhaps accumulate reserves through this, what we call sterilized exchange rate interventions, accumulating reserves. And in that way, we could insulate our monetary policy making domestically. But then with the sheer size of this response to the global financial crisis, with the unconventional monetary policies, and all this liquidity not staying here, but searching yields in emerging markets, so the old rationale of us central banks in the receiving end, sort of accumulated reserves through sterilized intervention in the foreign exchange market, I mean, that was not enough. The flows were so large that there was always money left on the table, and domestic credit was growing very fast, and so we had to use a broader set of instruments, these macroprudential instruments, to rein in the expansion of domestic credit, but also to put some sand on the wheels in terms of sort of slowing down the inflows into Brazil. Because the accumulation of Brazil was so much, the sterilization was incomplete, money was left on the table, domestic credit was growing very fast, so we had issues with financial stability. So what happens when all this money goes away? Then we'll have the whole financial system broke. And the proof of the pudding is that after all we had to go through, I mean, the financial system is there. We have other issues, but the non-financial private sector was able to endure a depreciation of the real, which was from 1.5 to the dollar to 4 reais to the dollar without a major financial crisis. And then the fund came with adjusting its advice. So allowing for, in this advice book to create this institutional view on how to deal with capital account regulations. So recognizing that countries have to resort to that in order to preserve financial stability. So I think that was a step forward in the policy advice from the fund.
Thank you, Mr. Tambini. Eswar?
So 2 points related by a common theme, which is that of trust. I'll get to that. If one thinks about regional arrangements like Chiang Mai and many others, the difficulty that you face is that they do not provide much protection from shocks that are common to the entire region, which is true of many of the sorts of shocks that emerging markets in particular are exposed to these days. So if you think about, say, Chiang Mai, it's not like there is a pool of money that has been committed and is sitting somewhere. It's a commitment by certain members to help out other members. So at a time of financial difficulty that envelops all the countries in the region, that commitment is likely to be tested. But in terms of many of these arrangements that we see, not just within but also across regions, including the ones that were referred to, I think there is a very critical element of trust missing here. It's hard to imagine that, say, Brazil or maybe India really wants sign-off from China before they get access to a certain pool of money. The pools of money in these things like the CRA and Chiang Mai are relatively modest, except for some small countries for whom, in relative terms, it is large. So it's not going to add very much. It certainly provides one layer of protection, but I don't think it's much of an alternative. When it comes to the swap lines, as Jose Antonio pointed out, those amounts are very large, but virtually most of those amounts and virtually all the amounts that were drawn from the Fed were by the ECB and the BOE, not by the emerging markets. There were 4 emerging markets that did get them. In addition to Brazil, there was Mexico, South Korea, and Singapore. Many other emerging markets wanted but didn't get that protection from the Fed. But it was the big advanced economy central banks that ended up using those swap lines. But I think the critical issue here again is about whether emerging markets feel that they can rely on the advanced economy central banks to come to their assistance at times of need, unless they happen to be good buddies with whoever is in the White House at the moment. And that, I think, points to the fundamental need for something that is, I think, a little different from what Jose Antonio suggested. I think it's not that you need no conditionality, but you need ex-ante conditionality with no ex-post conditionality, either in terms of access or in terms of amounts. The problem is that it's very, very difficult to separate those two. And especially for one institution like the IMF to manage that and the surveillance, I think is too much to ask of even a great institution like the IMF, but I think that's ultimately what we need.
Jim, just on the IMF and the evolution of its advice.
Yeah, this is an area where I'm going to have to disagree. And I think that the whole idea of trying to get rid of policy conditionality is a non-starter. If unless you're dealing with small amounts in a few countries who have a strong previous record. I mean, if I turn to Eswar and I say, "Could you lend me $10 until tomorrow?" He's not going to ask me what I need to use it for. He's probably not even going to care whether I ever pay him back. But would you lend me $10?
You don't know me well enough, Jim.
But if I go down the street to Chase Bank and I say, "Could you lend me $1 million? I'll pay you back in a year." They're going to say, "What do you need it for? Show me some performance record. I'm going to dribble it out gradually, depending on your performance, and so on." But if they're not going to lend me the money without conditionality. Now, on the other hand, if I go to Chase and I say I'm in trouble, I need $1 million to help me get out of trouble. Can you lend me $1 million? And they say, "Okay, here's what you're going to do. I don't care what you want to do. I'm going to tell you what you need to do over the next year so you can generate the performance that will enable you to repay this money and to make your life better." I'm going to say, I'm going to use profanity, and I'm going to walk out the door. And so, the problem is you need to establish a system in which there's a partnership between borrowers and lenders. If you don't have control by the lenders, they're not going to put their money up, they're not going to lend it. But if you don't have a partnership between the borrower and the lender, then the borrowers are going to resent it. You're going to have the kind of stigma that came to be attached to the IMF, particularly in the 1990s, which was when the density of policy conditions really hit its peak. Now, just very briefly to tell you a story about this. After I wrote my first history of the fund, I went into the policy department of the fund. And I led a team of people charged with trying to recast the guidelines that the IMF was using for its policy conditions. And the key thing we did to try to revise those guidelines, they came out in 2002, was to say we have to have this kind of a partnership. You have to give the countries ownership of the reforms that they're going to implement. Now, within the IMF, we got pushed back extremely hard by, I had mission chiefs. This is a true story. Mission chiefs came to me and says, you can't do that. These guys running these countries don't have a clue as to what they're doing. We need to tell them what to do or it won't work. And I had to say, that doesn't work. It hasn't worked. It's not going to work in the future. You need to have a partnership. So we got it through. There have been some big changes in the way the IMF does business. It's been hard going. I can't say it's working out perfectly, but I think it's made a big difference. And I think the fund can be very proud of what it's done with these new guidelines. So I think that's the way we need to be thinking about reforming the system so that you get rid of that stigma, but you still have the fund at the top of the system. In just 20 seconds, I think if you look at this question that Jose Antonio raises in his book, why does the Chiang Mai Initiative depend on good relations with the fund? Why do they require a fund program? Which is really what the Chiang Mai Initiative was set up to get around. But the countries in Asia that are putting up the money don't want that to lose control of that money. But they also don't want to have to go to the countries within their little club and say, here's what you have to do. They'd rather have the IMF outside the group telling them what they have to do. The same reason that the European Union insisted on having the IMF as part of the process of lending to Greece and Portugal and Ireland and other countries. So you need that apex group, but it needs to be done with a soft touch, and I think that's the way the system is moving, but it's moving slowly.
Thanks. I like the word soft touch. But let me turn to Edouard. You have a two-hander. Yeah.
Yes, so I was ready to give you the $10, Jim, but now I'm a little unsure. So I think there is a fundamental difference here between what you characterize, which is lending, and insurance. And I think those are fundamentally different concepts. If you're thinking about insurance, it's based on criteria that the lender sees in advance. And it's not really insurance to get over solvency problems. In fact, I call my proposal global liquidity insurance for a very specific reason. If you think about Greece walking in the door, Greece would not qualify because based on their, and again, this is just like insurance. When you have a car accident, you don't have Geico telling you you need to do certain things from now on. You get the money because you have paid upfront through the ex-ante conditionality through the premiums that are based on your history of driving in terms of whether you've had accidents or not, in terms of your good behavior on the road and so forth. So that sort of conditionality ex-ante, but without, again, any restrictions exposed is the critical issue. So the analogy between lending and insurance is not, those are not the same thing. But having said that, the issue really here is whether you have the insurance in place provided by the right kind of insurance provider. And it cannot be insurance that essentially gives you money. So if you think about insurance in this context of, say, Greece again, if Greece was getting money to get over solvency problems, there, everything you said is exactly right, because you cannot give a country that has solvency problems money without imposing conditions on them. But if you have a country that has a liquidity problem, and what the country gets is a one-year line of credit, non-renewable, that is a very, very different ballgame. If you provide that line of credit, that gives a country with good policies exactly what it wants in terms of protection that it now gets from foreign exchange reserves. That is the ability to get over liquidity problems. So in fact, if you could separate these two elements out, certainly in the midst of a crisis, liquidity and solvency are a little difficult to tell apart. But very often liquidity crises turn into solvency crises, which is precisely the concern that many borrowers, many emerging market countries have. So the proposal I have is not for lack of conditionality in lending. In fact, in that context, I think it is crucial. But for insurance, you cannot have exposed conditions linked to access or amounts.
Well, thank you very much. I'm going to take the moderator's decision to end the event and to close it. I'm sorry that we couldn't take one more question, but I think it was a provocative exchange of ideas. Now, we have a panel that provoked Jose Antonio and gave provocative comments to the ideas that Jose Antonio put forth in his non-book. But I think the result has also been a lot of insightful comments that I think could really inform what might be done in the future and what might be the options out there that could be explored to redress in a way the dysfunctionality of the current international monetary non-system. Thank you very much, and I hope that you found this panel and this panel discussion and presentation interesting and useful. Thank you.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.